Michael Hartzman. Today is Tuesday, November 4th, 2025, Election Day around the country. And I'm on, as always, with my partner, Dominick Tavella, both of us coming from Long Island this evening. How are you, Dom?
Doing well, no complaints, Mike. Happy to be back on set with you and hopefully having a decent, wonderful discussion.
Yeah, I look forward to it. I mean, Sunday was daylight saving, so lo and behold, it is dark behind both of our shoulders this evening. That happened kind of quickly, don't you think?
It caught me a little bit by surprise, but I've been in a mode for like the last month of switching time zones. And then just as soon as I thought I was getting my feet on the ground, I got hit again by a time change. So I guess we'll all adapt, but no one's ever still been able to explain to me why this makes any sense.
Yeah,
So I'll leave it to the really bright people in the room to figure it out. But that sure isn't me.
I got you. Um, well, look, we're jumping into what is supposed to make sense for us. We could talk about the market, and frequently that doesn't make sense to us either. But let's just do a quick review of the numbers, which are a little outdated already because today was a little bit of a sell-off. But year to date through Friday, no, I guess Friday of Halloween, October 31st, first month of the quarter. The year to date, the S&P was up 17 and a half. The Dow was up 13.3. The Nasdaq was up 23.5. And you know what? We're going to focus on international a little bit because we have a specialist tonight going to do a deeper dive. We've been talking about international really leading the pack all year long, and it's no different this evening. The MSCI EAFE index was up 27% year to date. And the MSCI Emerging Market Index, Dom, is the big winner of them all, up 33.5. And for the longest time, emerging market didn't get any love at all. But but that all changed a little bit today as there was a little bit of a sell-off, which is to be expected. The market has done phenomenally well, led by tech, led by AI, led by, the dust is settling a little bit with the tariffs. The Chinese and the US are making nice to each other. So there were a lot of positive things happening the last couple of days and weeks, and the market was kind of taking it all in.
Yeah, Mike, and we can focus on last week and the week before, right? Overall, the major indices were up, and not only were they up, but they were up substantially. But when you started digging a little bit under the surface, the picture didn't quite look as good. And frankly, I'll go as far as to say there were some pretty good storm clouds out there, hidden by the major indices, by the performance of these very concentrated markets. And we won't get into too much what happened today, other than to say that maybe some of the storm clouds are coming out. So one quick factoid, Mike, even though all the major indices were up last week, when we look at the equal weighted S&P 500, where all 500 companies count the same, that index was actually down 2.5% last week. So it's a really big tell, the disparity between the average stock out there and the concentrated big mega growth stocks in the Nasdaq and the S&P 500. So we're seeing a real broadening in that disparity. And that's
Yeah, and I,
public.
and I and I know you enjoy talking about and pointing out and studying the equal weighted S&P 500 and just I know I've done it before, but for the benefit of any new listeners tonight, why don't you explain the difference quickly between what we know as the common S&P 500, the way that's measured, versus the equal weighted S&P 500, which is measured way differently.
Way differently. So the number we usually see on the news at night or during the day, when if we're watching one of the CNBC channels or business channels, is the market weighted S&P 500. Well, the problem there is that some of the companies in that index have gotten so large, and the one that comes to mind is Nvidia, now worth $5 trillion. So one stock in that index is worth 5 trillion. I think that's more than the bottom 200 stocks in the index. So
Combined.
Combined, you're exactly right, Mike. So if Nvidia goes up $1, it just weighs more, it carries more weight than if the bottom 100 go down $1. The index. So when we look at the index, the one that everybody, the market weighted one, there is, oh, it's up year to date, it's up over 17%. But the majority of that performance is literally less than a dozen stocks. And if we look at the equal, we're just going to count every company the same. That index is up only 7, 8% year to date. So there's this disparity of the really, really high growth stocks have done way better than the rest of the market.
Yeah.
It's a very concentrated portfolio.
Yeah, I mean, it's a big difference. It's 10 percentage points. It's a
Yeah.
lot.
And that
Um,
gap, Mike, is really large relative historically. There's been a gap, but this one has been pretty large. We have to go
and,
back a long time to see anything like that.
and look, it's not a new story because that's all part of the whole Mag 7 story that's been bubbling around for 2 years already. Um, but what I want to switch gears for 2 seconds, and I want to talk about the government shutdown. Because to me, Dominic, I don't know economically how this is not a story, how this is not being talked about, how this is not part of the headwinds for the market. This is going to be the longest shutdown on record. And it may shatter it may be like Joe DiMaggio's 56 game hitting streak that no one's ever going to come near.
I
This
hope.
thing's this thing's going to go on and on and on and on because it's not even talking. At what point does this go from being a headline risk to a real risk? And when are people going to start talking about the trickle down or domino effect of not only these government workers not getting paid, but how that affects cascadingly everyone in every business around them?
Yeah, Mike. So, at the risk of not burying the lead, there were some pretty significant people in the world thinking that it wouldn't get resolved before the election today, that politically it made sense to let it run through today, and that within a week or so we might finally see a resolution. But to your point, Mike, these are real people that have mortgage payments and they have rent payments and car payments and they need to put food on the table, and the politics around this are just frankly nauseating. They are absolutely disgusting because it's real human beings out there that are struggling to put food on the table and pay their bills. And I guess everybody's playing the game for political reasons, but unfortunately, real Americans are really suffering. And that's just a shame, Mike.
Yeah, and I obviously agree with you, but it's them, it's the communities they live in, right? It's the local restaurant they're not going to. It's the dry cleaner they're not going to, and a little bookshop they're not going to maybe
Yeah.
buy an extra book. So it's not even them. It's, as I said, it's everyone around them who live.
And Mike, I'm just going to add to your fire here. So even if you are working, think theoretically you're eventually going to get paid. There's certainly that fear that you might lose your job. And so that means, hey, maybe we're not going to go out to dinner. Maybe we're not going to go on vacation. Maybe we're not going to go shopping. And that's the economic effect that you're talking about. So not only are these people suffering, but I really genuinely believe the communities around them are also
Yeah.
hurting.
Yeah, and look, I hope you're right, that it does get resolved in the next week or two. And I certainly hope, to your point about this real suffering, that these politicians on both sides were not playing politics and delaying it till after the election day because they had, political ground to win. But to me, they just appear so dug in on both sides that I don't know what gets them to the table and who blinks first.
real people calling their congressmen and women and saying enough is enough, and I will change my vote if this doesn't get resolved. But until people step up to the plate, Mike, and make real threats about how they're going to vote going forward, how they're going to react currently to this political agenda. They don't have a motive. Look, I don't want to paint them all with the same brush. There's a lot of very hardworking politicians out there that are kind of caught in the middle. But boy, oh boy, we're not normally a political show, and I don't want to start now. But this has to come to an end. And I hope to God some price does get paid, some pound of flesh does come out, i.e., at the next election, people don't forget how this went down.
Yeah, and look, it's not, and you're right, we're not a political show, and it's not about politics as much as the economic damage that could begin to trickle in if you're wrong and this thing does not get resolved in the next, 10 to 14 days.
But Mike, you hear the stories as I do, where the food stamps are not going out, and airline traffic controllers are not getting paid. They're calling in sick. People are going to get Uber jobs and delivery jobs to make an extra buck. This is real world now. I mean, the first couple of weeks, people got paid anyway, so it didn't really affect them. But we're way past that point now. Way past that point.
Yeah, I'm with you. We're in total agreement, which we typically are, but we're totally agreement on this one. So to switch gears, I would say about 6 weeks ago, we had Anjali Balani in our office. JP Morgan, our local JP Morgan advisor, Mike Valent, was traveling with her. As always, he made the time to have her visit us in our office. Anjali is a managing director, head of investment specialist team, specializing on international equity. And the reason I wanted her on the show, and I'm thrilled that she was gracious enough to make the time this evening, is she would be the first to tell you that international investing has truly been the redheaded stepchild of the U.S. investing world for a very, very, very long time. And that day in our office, she was making the case why that has changed, not will change, but has changed. And you and I all year long, when we do the numbers, have been talking about how well both, developed and emerging markets have done. So I think, her timing and being on the show tonight, Dom, is going to bring a fresh perspective on, quite frankly, a topic we haven't, I don't think, spent enough time on.
We've certainly talked about it, but
Yep.
not in great detail, Mike. And I have to say, both poking fun at you and myself, we go to these conferences all the time, some of the most brilliant people on the planet. And the first thing is, oh, you got to put it international. And you and I look at each other and laugh because for a decade, this has been an underperforming asset class. It looks like maybe the tide has turned, and I think that's healthy. I think we should look at it, especially our industry, in a global way, in a global economy. But I think we have somebody tonight that can enlighten us a little bit and hopefully guide us in a better direction.
Yeah, and just to be clear, I don't want to get her in trouble with the folks at JP Morgan. She did not use the expression redheaded stepchild. I use the expression redheaded
Well, the only
stepchild.
one you're in trouble now with is my wife, but that's a whole different conversation. Um, but in
Patty
terms
loves me.
of globally, internationally, it certainly is top of the list this year, and hopefully continues so going forward.
Absolutely. So on that note, we will be right back with Anjali Balani from JP Morgan. All right, I'm Michael Hartzman, back with my partner Dominick Tavella and our guest this evening, Anjali Balani. She's with JPMorgan Asset Management, a great friend of our show. She's managing director and head investment specialist on the international equity side of the house. And Anjali, when we met a couple of weeks ago, you clearly were excited about the opportunity in international, and Dom wasn't joking. Sometimes over the years, we felt like a stopwatch is right 2 times a day. And 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 we were always very skeptical about this sector. You were extremely enthusiastic when we saw you. So why don't we just start right there? What's kind of different now and what's kind of lined up for you and your team to feel that the international sector kind of is going to have its moment in the sun?
Well, Michael and Dominic, it's a pleasure to be here. Thanks so much for having me. And it is worth mentioning that international is already having its moment in the sun, not that it's going to. And I think the question is also just why do we think that that outperformance that we've been seeing from international compared to US equities could be sustainable this time around? And one thing I want to just preface all of this is by saying that this is not a call on sell your US equities and buy international. But I think the big call to action is that if you have owned no international or you've been underweight international, that you should actually feel quite comfortable with closing that underweight to international because that sort of alligator's mouth of underperformance that you are used to seeing over the last 10 to 15 years versus US equities is unlikely to repeat this time around. And I would really just call your attention to three key reasons for why that is. I like to use the acronym CVS because hopefully you remember it as like the place you go for prescriptions and think about this as your prescription for international equity outperformance, where the C stands for currency, the V stands for valuation, and the S stands for sentiment. And if you unpack all three of these, starting with currency, the fact that coming into this year, you had a very strong dollar, arguably an expensive dollar relative to its own history, relative to other currencies. We know the dollar has already depreciated this year by almost 10%. That's pretty notable. And if you think about why you want to invest in international, a weak dollar environment is a big boon for international equity investing. And so that currency weakness, that dollar weakness, is actually translated into greater returns from international equities. So currency has been a friend this time, whereas over the last 10 to 15 years, currency has certainly been a foe for international. The second one, valuation. If you ever heard an argument around international, it probably was focused on it's cheap. The thing is, when you see the S&P 500 trading at 23 times, and even some of the more recent wobbles that we've seen today, the first quarter of this year, DeepSeek Monday, a lot of that had to do with markets being a bit scared of the fact that the S&P or the Nasdaq are looking a bit elevated in terms of valuations. And we've now gotten to valuations of the S&P that we last saw in the peak of 2021. I think what's important to mention here is that international is still cheap. It's trading at a 35% discount versus the S&P, two standard deviations away from average. And so if you're looking for opportunity in the market today, you can still look at it international. And the good news is at these sort of valuations, if anything goes wrong, it feels like you're jumping out of a basement window as opposed to jumping out of the attic for the S&P. And then the last one on sentiment, and we can unpack this in a great bit more of detail, but you are seeing markets around the world embracing international in a way that we just haven't seen over the last 10 to 15 years. So clients are already allocating here. And I think a lot of that shifting sentiment has to do with a variety of things. But one of the most notable news events this year was Germany coming out with a huge plan on spending about $1 trillion on defense and infrastructure. Now, that's meaningful because this is a country and a region, frankly, that has gone from almost a decade now of fiscal austerity to now actually talking about fiscal stimulus. And that fiscal stimulus can add about 3 percentage points to German GDP over the next 10 years on an annual basis. It's meaningful at a time when we're a bit more worried about growth prospects here in the US. And so that sort of delta of change is a big, meaningful change in terms of broader sentiment. And it's one of the reasons, in addition to currency and valuation, that I think we should be paying a lot more attention to international and that you should feel a lot more comfortable with that allocation given our much more constructive stance.
Anjali, to your point, if we look at the last 10, 15 years, the US markets have way outperformed foreign markets. But a big reason of that is these large tech companies that we have here, not so much abroad, especially when you think about Europe, maybe some a little bit in China, but they don't have these large cap growth tech stocks like we do. And clearly that's what's buoyed the market for the last 10, 15 years. Focusing on Europe and around the world, they still don't have those kind of companies. So can we really say valuations are cheaper there, or it's just that they don't have the kind of companies that we have here? They don't have them there.
So, Dominic, I completely agree with you. International stocks do not have the same exposure to some of the best companies in the world, frankly, that are sitting right here in the US. And the reality is, we have plenty of exposure to all of those companies and should continue to have exposure to those companies, albeit with some risk controls in place so that you're not overexposed. I think what's important to mention, though, is when we speak about valuations for international, every single sector internationally is trading at a discount versus that same US sector. That's an anomaly. That's not something you see very often. So this isn't an argument of tech versus everything else. This is that you're just in the wrong zip code if you're international. And
So
frankly,
you're comparing financial companies here to Europe
exactly
or
right.
around the world, or energy companies valued here, and they're still a lot cheaper abroad than the.
Every sector, exactly. So if you compare international healthcare to US healthcare, if you compare international energy companies to US energy companies, which by the way are all drilling from the exact same places, are all subject to the same price of oil, these are anomalies that we don't expect will continue to play out over time. This is a very compelling valuation argument in my mind because that's not something we've seen years ago. And I think that that will be one of the reasons why that valuation gap will continue to close. It is worth mentioning it's already been on the journey of closing this year. We started this year with international at about a 40% discount versus the US. We're now sitting at about 35%. But I mentioned that because if the question is, well, did you miss it? International is up 27% as you started the call with. Yes, that's a pretty strong rally. It's 10% ahead of the S&P at this stage. But having said that, it's still deeply discounted. And so I don't think you've missed it. There is still some time to be adding to that international allocation.
So, Anjali, is this a sector story, or is this a country story, or is it both?
I think this is a diversification story. And the reason I say that, and you rightly pointed out that when you think about the S&P, I mean, if you actually look at the top 8 stocks in the NASDAQ 100 today, those are the same top 8 stocks by market cap for the MSCI World, meaning the top largest companies by market cap for the NASDAQ 100 are the same largest 8 companies by market cap in a global index. And so that's a reason that you should be a bit concerned around, do I have way too much equity exposure to the same group of stocks that are already taking up a big part of my portfolio? And when you're owning international companies, the reality is you are not getting the same exposure to these AI beneficiaries. You are not getting the same Mag 7, if you will. What you are getting is actually about 50% of our index is exposed to sectors like financials and commodity related sectors. And the reason that that's important from a diversification perspective is on those days where US growth zigs, you can actually get that international equity exposure to zag. It used to be that all equity markets used to be highly correlated. But we've actually seen, whether it was on DeepSeek Monday, whether it was the full first quarter of this year, whether it was calendar year 2022, which we've all sort of forgotten and moved past, a year when US growth was down almost 30% in the calendar year. Even your fixed income was down double digits in a year like 2022. Where you can really get your maximum diversification bang for your buck is if you actually pair that US growth exposure, which we all know and love and have plenty of exposure of in our portfolios, actually by pairing that with international value. Meaning, and I say it sort of out loud, everything that, US growth stands for, the opposite is really what international value is, where you get plenty of exposure to banks, to energy, to utilities. And yet, when we have seen US growth zig, international value has zagged. It was positive on DeepSeek Monday. It outperformed US growth by almost 20% in the first quarter alone. And in a pretty terrible year like 2022, international value was only down 4%. So it is worth thinking about the role that international can play in a portfolio from a diversification perspective, and even the added benefit that you get if you style box that international exposure, particularly the pair of US growth with international value.
So I'd like you to focus just a minute. You've already brought it up, but the currencies, the US dollar getting weaker, and we're going to focus on the euro for this discussion, getting stronger. That 27% really is not all the performance of the stocks. Part of that is the performance of the currency, right? So I think there's a lot more value there that maybe that top line number hides. How much of that 27% was just currency play?
So if you're looking at 27%, that's speaking to MSCI EAFE, which does include not just Europe, it includes Japan, it includes your PACX Japan as well. If you're just looking at Europe itself, Europe in US dollar terms has actually given you through last night 35% in returns. The vast majority of that 35% has actually come from multiples expanding, meaning valuations have started to creep up for Europe, which is great. It's been a while, frankly, right? It's been overdue. But it is worth mentioning that about a little over 12% of those returns has come from the euro appreciating. And so if you were planning your trip to anywhere in Europe, last year was the right time to go. This year, it's probably feeling a bit more expensive to go because your dollars are not getting you as many euros this year, given that appreciation that we've seen from the euro. But to be honest, this is something that we've been waiting for. We've been wanting a weaker dollar for some time now. And the reason for that is because if you have a strong dollar, as we've had for the last 15 years, where the dollar appreciated by 50% relative to other currencies since the '08 crisis, that made the dollar very expensive. And it was really difficult for international to outperform when you have this huge headwind being a strong dollar in front of you. All of a sudden, what has been a huge headwind with the strong dollar has turned into a tailwind for international returns and, in particular, European returns that most of you didn't have on your bingo card coming into this year, that Europe would be up 35%. And I think that this is, again, just a call to action to think about. It's not just about, currency that plays a part in your returns. That has been a big part of returns this year, but it's also been valuations that have been expanding. It's been earnings growth that's been positive and growing. And also remember, international stocks in general, and Europe in particular, tends to give you a nice, attractive dividend yield, especially when you compare that to the US. And so when you think about those four total sources of return, your valuation, your currency, your earnings growth, your dividends, that's what actually sums up to the total returns that you see on your statements on, CNBC and so on. That is important to bear in mind. It's not just about one of these in a silo. It's about thinking about all of them together. And that's why you can get some pretty eye-popping returns as we've seen this year already.
Anjali, when I was, at JP Morgan's headquarters last month at the symposium we got invited to, one of the speakers, who I'm not going to name, basically said that England is still suffering. Brexit was a mistake. There's no turning back. So, you mentioned Europe, you mentioned the euro. Where does the UK, fit into all this growth? And do you agree, that Brexit was probably a misstep? And what does the UK do going forward?
So the majority of my team sits out in London, and I don't think there's anyone I've spoken to that thought that Brexit was a good idea. I think we can all agree that that has probably been a big economic blow that the UK has had to deal with. Um, I think what's important to bear in mind, though, is that the economy does not equal markets. And the reason I think that that's really important is because if you think about the UK equity market, you're not really talking about stocks that are leaning into the domestic story in the UK. The majority of stocks, when you're looking at the FTSE 100 or any sort of UK listed set of companies, they're all export oriented. There are companies that might be listed in the UK, but actually the majority of their revenues are coming from outside of the UK. So yes, a slowing UK economy isn't great for maybe some of those more domestic facing companies. Think about your utilities, think about telecoms, companies that are essentially exposed to the domestic economy, if you will. But think about all of the consumer brands, the luxury goods brands, companies that you are very familiar with that are listed on a UK exchange. They are not really exposed to what Brexit meant. Of course, anytime there's any sort of political upheaval, which we are no strangers to here in the US, given all the tariff noise this year, it does create a slowdown in activity. Everyone's trying to wrap their heads around what this actually means, and it's hard to it's growing pains as you're trying to figure it out. And I think the UK will see it through over the long run. But it is worth mentioning that when you're investing in the UK market, it's not about Brexit. You're investing in companies, and these companies are not exposed to the UK domestic story. By and large, they are exposed to the global growth story. And even if you look at the latest readings of PMIs, the Purchasing Manufacturers Index, which gives you a good snapshot on manufacturing momentum around the world, what you'd notice is actually there has been this greening of the lawn, if you will. Yes, there have been a couple of red spots. France, in particular, has been dealing with some political upheaval of late. Brazil is seeing some slowdown. But apart from these two in particular, you are actually seeing all countries around the world in pretty decent shape, which gives you a snapshot of actually we're not in a bad scenario right now. And if you see global growth being quite stable and growing, that should be a pretty good backdrop for a lot of these export-oriented companies.
Angela, you brought it up. Oh, we're seeing quite a bit of upheaval on the political front, and you mentioned France, but Japan's got a new prime minister. Italy has a relatively new one. We know what's going on in the UK. Germany's gotten its own political. Some of it's more conservative governments coming in, maybe more fiscally responsible. Do you look at that political scenario in terms of its economic impact, and what do you think going forward?
Of course, we look at that. I mean, it certainly has created a lot of noise. We look at it here in the US every day, right? The news flow is hard to wrap your head around on any given day. I think what's been notable is some of the changes that we've been seeing on the political stage across Europe and Japan has actually been moving in the right direction. And what I mean by that is in Germany, for example, they were able to release that debt break so that finally they could actually go from, what has been a pretty attractive debt to GDP of only 60%. Now they can spend and they can let that debt to GDP go a little bit further than where they've been. And so that has allowed for the fiscal stimulus announcements coming through from Germany. And it is worth mentioning Germany can spend because at 60% debt to GDP, if you compare that to US debt to GDP, which is approaching 120%, it's pretty noticeable. So they're in a good shape actually fiscally, and it's a great backdrop for them to continue to promote that sort of stimulus. What is worth mentioning too is the most recent elections in Japan were also seen as a broad positive in terms of more fiscal stimulus in Japan as well. So these are good signs, I would say, but at the same time, important to keep in mind, we are not investing in countries or economies. We are ultimately looking to pick those best stocks.
Angela, this is a great spot to take a break, take a breather, and then when we come back, I want to jump off with tariffs. You mentioned them briefly. I don't think we could, not talk about tariffs, and how it affects the world and how these countries are adapting. So let's take a break here, and we'll be right back with Anjali Balani, Managing Director at JPMorgan Asset Management. All right, I'm Michael Hartzman, back with my partner Dominick Tavella for our last segment of the show tonight with Anjali Balani, Managing Director at JPMorgan Asset Management, Head of an Investment Specialist of the International Equity Team. And Anjali, we can't let you go without touching on tariffs. I think everyone would agree the rollout back in April was kind of haphazard, it was chaotic, it was confusing. So here we are 6 months later. The dust has kind of settled. A lot of countries are making nice with each other. What's JP Morgan's take now, 6 months later, about how the tariffs are they working? Is there still a lot of unknown? Where are we?
So, tariffs did create a lot of upheaval, and I would say that we're still not in the clear yet. What has given us some reason to remain quite positive through all of this is that even though there were some big numbers that were thrown around and some numbers that really spooked markets in the interim, it seems like, as you said, Michael, everyone is playing nice, and we've come to some sort of reasonable agreement where, most tariffs have settled around 10 to 15%. By and large, yes, there are a few outliers, if you will, but I think reason has actually shown up in a lot of the ultimate numbers. It is worth mentioning, though, that tariffs are still inflationary. They're also a cost, and at some point, you need to be able to look through the numbers in order to understand who the ultimate payer of these tariffs will be and what sort of cost we're going to have to pay for them. Does this hurt the consumer long term? That's a big question, and it's something that I think we'll need to figure out as we're trying to understand who the end markets are for some of these companies that we're investing in. As it pertains to what this means for the US, especially we talked earlier about how the US is sitting at debt to GDP of around 120%. The deficit is a bit worrying. The fact that tariffs can bring an additional source of revenue, I think is a good thing for the US. But having said that, it's not a bad thing for anything outside the US, any country outside the US. Keep in mind that, the US essentially with tariffs has picked a fight with everybody in the playground. Whereas, when you're France, when you're Japan, yes, the US is a hugely important trading partner to you, but it's not your only trading partner. And so the rest of the world may move on. They'll figure out other ways to, fill their buckets back up again and try to, find ways to replace what they're losing from US revenue as a result of tariffs. I also think that when we're looking through on companies that are best positioned against this sort of tariff noise, companies that may be international in nature, but actually have a majority of their operations here in the US or are vertically integrated within the US and can manufacture their products here, are probably better positioned than those that are making all of their products outside of the US, where they are more exposed to a higher tariff cost as a result of that. So, again, it's important to be very selective when you're thinking about who the relative winners and losers could be against this tariff noise. But as it pertains to the economy in the US, it seems like tariffs have actually created a pretty good source of income going forward. And so long as they are deemed legal, I guess we'll remain watchful to see how this plays out.
Anjali, I don't mind raising my hand on this one. I got it completely wrong. We thought tariffs paid by other countries, companies, whatever, would have a significant effect on those economies. If they couldn't produce the cars to sell them, if they couldn't manufacture and sell it into the US, or if they had to higher prices and absorb some of those costs, profits would go down. But it doesn't seem like that's really happened. It seems like they've done a really good job of adapting. So maybe just another minute on how they've been able to do that.
So, I do think that tariffs have created a bit of noise for some companies more than others. What I think is important to mention is if you look at companies internationally, against all the tariff noise, more of the growth companies or those companies that, are more exposed to global trade have underperformed the international value companies, if you will. So, in this environment, against all the tariff noise, actually, the more domestic facing you've been, the better off you've performed because you're less exposed to all of the noise that tariffs have created. And so in this year, you would have been better served to actually have more bank stocks in your portfolio, as an example, versus, say, consumer staple stocks that are a lot more exposed to all of this trade. Having said that, going forward, I don't think you can derive too much from what the prior administration looked like with tariff noise compared to what it looks like this time around. Because remember, beyond just tariff noise, it goes back to my CVS on why international has been able to eke out these returns: currency, valuation, and sentiment. And bear in mind, tariffs have actually played a part in a weaker dollar this year because countries around the world have wanted to protect themselves, essentially. They've had a lot of exposure to US denominated assets coming into this year. All of that tariff noise created a bit of a spooky environment. We're not too far away from Halloween a couple of days ago. And that led them to actually take some capital out of those US denominated assets and bring them closer to home. That has had a negative effect on the dollar. It's been one of the reasons why the dollar has depreciated by almost 10% year to date.
Anjali, you just took the words right out of my mouth. That the 10% sell off, I was going to ask you, isn't that an unintended consequence that the US had to suffer when they announced all these tariffs? Is that countries are saying, great, if that's how we're going to do this, then we don't want to own your dollars.
Yeah, I mean, there's been a multiple layer effect in terms of why the dollar has weakened this year. But I would say that the trigger of a lot of it had been all of the tariff talk at the beginning of this year. Of course, we know that the dollar was already expensive coming into this year. Over time, you tend to see, currencies get back to purchasing power parity. The fact that also the Fed is embarking on a cutting cycle means that the US is not the only yield game in town anymore either. So that also had a negative effect on the dollar. But absolutely, Michael, the fact that we've had all of this tariff noise and that countries around the world are looking to reshore some of their currency away from US dollar denominated assets into more local assets has certainly played a part as well.
If we can just switch maybe to country discussion. I mean, we in the past, China's growth was phenomenal. India's growth was phenomenal. The world is changing. And what do you guys see coming down the pike? What countries are going to benefit from the changing cycle, and what countries like maybe China might languish a little bit behind?
So one thing that I think is underappreciated is all of the corporate reform that's happening around the world. You've seen it now for a few years in Europe. You've been seeing it in Japan. And this year, one of the reasons that Korea has had one of the most breakout years in terms of returns is because they've had something called the Value Up program. And what all of these have in common, whether you're talking about Europe, you're talking about Japan, you're talking about Korea, is the fact that companies are taking a page out of that US playbook and they're thinking a lot more about what they can do to return more capital to shareholders. In the past, you would find that a lot of these companies would have cross shareholdings within each other. They were historically not the best stewards of capital, if you will. And in fact, what you're starting to see is they have been on a series of buybacks, whether that's been in Europe, in Japan, or in Korea. And what that's meant now is that buyback yields in Europe have actually eclipsed buyback yields here in the US. And in Japan, you have seen a flurry of buyback announcements ever since the Tokyo Stock Exchange came out with guidance last year that basically said if you're a company that was trading below book value, you would risk being delisted from the Tokyo Stock Exchange. All of a sudden, you're starting to see a flurry of buyback announcements, and you're seeing the same corporate reform in Korea. Why I think that's so important is because we know what buybacks have done for US stocks over the last 10 to 15 years. It's boosted earnings per share growth, EPS growth in the US, because as you're buying back more shares, it signals to the markets that you think your companies are attractively valued. Buybacks have accounted for almost 50% of the S&P returns over the last 10 to 15 years. Tech has played the other, 50% of that. And so if we continue to see these reforms happening across Europe, across Japan, across Korea, that's a great signal that from the bottom up, companies are doing something different. They're actually being run in the best interest of shareholders, and that's a great signal for future earnings growth for these countries.
Anjali, you mentioned China a couple of times, and China is still categorized as emerging markets, which is so confusing to me. What is the mechanism, or what is the method, if any, that the second largest economy in the world, probably will be the largest economy in the world at some point, is no longer considered an emerging market? Or maybe I should ask, what makes it an emerging market today if it is the second largest economy in the world?
So, the reality is, who knows when an emerging market actually does emerge. We tend to stay very close to index providers' definitions, if you will, about what's an emerging market versus what is a developed market. But if I think about, why China could continue to be an emerging market, there's a couple of things I would look at. Number one is the urbanization of the population. Secondly is the literacy of the population. Third is around, is this more of a manufacturing economy, or has it grown? Has it evolved to become, to go away from manufacturing or agriculture into maybe some higher value add parts of the economy like services, which the US certainly has emerged many, many years ago, to focus on. And so those are some of the things that I would be taking a close look at in terms of how to think about China, or any emerging market, for that matter, in terms of whether they're emerging. I think the other part that is important to bear in mind, especially given how reluctant many of us were to invest in China over the last 2 years, is that the regulatory environment made us call into question to what extent China is even investable. Are these companies really independently run, or are they being sort of, puppeteered by a broader government? And, how strong is that regulatory hand? And all of that plays a part into how you think about the risks associated with investing in companies that are listed in these countries.
So, speaking of that, and Dom, I apologize, just one follow-up question. Do you think Chairman Xi of China likes being categorized as an emerging market? Or do you think, because he is very prideful, he prefer them not being categorized as an emerging market?
I mean, I think as it stands still today, China is still the largest country that is part of an emerging markets index. It probably helps more than hurts to be the
Hmm.
largest because that means that you are on the receiving end of capital flow. And so I don't really think that he stays up late at night worrying about this. I think there's a lot of other things he's probably more concerned about. I don't think that this has been a hindrance for China at large to be able to be on the receiving end of capital flow, by being categorized as an emerging market.
Maybe a minute of focusing on the opportunities of emerging markets. I've personally spent some time in South America and Africa, other parts of the world, and it really is mind-boggling how much opportunity there is there. But are we in a position to take advantage of it? And how much of a client's portfolio should be focused on emerging markets?
I mean, those are good questions. It is worth mentioning that just when it feels the most uncomfortable to look at a certain market is probably exactly the time that you should be considering an add to your portfolios. And if you asked anybody coming into this year if they had any appetite for any China exposure in their portfolios, I think you'd probably find a pretty resounding no across the board. And yet, who would have thought that essentially through last night, China's up almost 40% in terms of, dollar denominated returns. And so I think that this is a lesson for all of us that we should always ask ourselves some of these natural questions and question some of the biases we've had, because frankly, you do lose out on some of these returns. And oftentimes when we start to invest in China, we're starting to chase some of those past returns. If I'm thinking about the case for emerging markets or even China today, I'm thinking, well, you know what? The valuations at 14 times earnings for emerging markets compared to 23 times earnings for the S&P 500 look pretty compelling. But I would also bear in mind that when you're investing in emerging markets, you need to have a long-term mindset. This is not a market that, you dip your toe in and then, get get scared and then get out at the wrong time. Frankly, if you miss some of those best days in emerging markets, you would have seen your returns essentially half over that time. So if you are investing in emerging markets, I think you have to ask yourself a couple of questions. Number one, do I have the risk tolerance to do so? Because inherently these are riskier than some of the developed market stocks for a variety of reasons. And also, number two, do I have that sort of time horizon when I am investing in emerging markets? Am I going to be that person that's going to make the call and say, please sell all of this? I can't handle the news flow around this. So I think those are some important questions. And then once you get over that, in terms of what percent of your portfolio this should be, if you look at the MSCI ACWI, which is your all country world index, it includes the market cap of every single traded stock around the world. And if you think about the MSCI ACWI, about 10% of that index is in emerging markets. And so if you're looking at 100% equity allocation, sort of that to me is the highest bar of how much you want to have exposure to emerging markets. I think you then adjust for that based off of your risk tolerance. You adjust for that based off of the fact that you live in the US, you earn in US dollars, your debt is denominated in US dollars. So maybe that objective answer is your threshold of how much you should have in emerging markets. And you can then just account for some of those factors, and perhaps you end up with somewhere between 5 to 10% of an overall equity portfolio being invested in emerging markets.
So to that end, you clearly said when we started the show, this is not a reason to sell your domestic investments, right? So you were very clear on that. And thank you for that. What percentage would you recommend for a typical 60/40 blend to have, developed international investments?
Yeah. So, again, I would bring it back to the MSCI ACWI, taking a look at just objectively, if you're looking at what percentage of a global index is in US stocks versus everything else, US stocks represent about 65% of that index. It peaked at 70% actually at the beginning of this year. It has been coming down, but still very concentrated in terms of the US exposure of that global index. And if you think about emerging markets, that's another 10%. And so that leaves you with 25% that's in developed international. Again, if you're looking at a 100% equity portfolio. Now, if you're taking 25% of 60, you can basically get to what that international exposure is in a 60/40 portfolio. But by and large, the majority of your equity portfolio, we would expect to still be invested in US equities. This is just a matter of taking some of those US equity chips off the table and thinking about some diversification outside of the US that could provide a zig when the rest is zagging, given just how growthy, how tech heavy the US markets have become.
Dom, you get the last question this
Yeah,
evening.
we only have another minute, but I really would love for you to concentrate your last 2 minutes on there's still value on the international space, no matter how well it's performed year to date.
So, I think that as you look at days when the S&P sells off or the Nasdaq sells off, it'll be important for you to take a look at what other equity markets are doing. Because at the end of the day, this goes back to why I think international plays a role in portfolios, and that role is diversification. So again, this is not to say that you're trying to trim US equity exposure or sell all your US stocks. It's just about thinking about taking some chips off the table. This has been a formidable investment for you. We know just how much US equities have delivered in portfolios over the last several years. And it's not to say you still can't continue to have that exposure, but it's all about rebalancing and looking at some other parts of the market where there are still some very attractive valuation opportunities. And with international still at 2 standard deviations away, cheap versus the US from its longer term average, that to me is a pretty compelling story, especially when you have a weaker dollar that we're expecting going forward, pretty strong earnings growth, a better dividend yield, and also some of the buyback reforms, corporate reforms that we're seeing happening around the world, Europe, Japan, and in emerging markets as well.
Excellent.
Anjali, thank you for your time tonight, and thank you for making the case for international investing. And as always, thank you to JPMorgan Asset Management. We appreciate you being on this evening.
Oh, it's been my pleasure.
Thank
Thanks
you
so
for
much for having
joining
me.
us and giving us a very concise, clear answer. Appreciate it.
My pleasure. Thank you both.
You're welcome. And we'll see you next time on the Lebenthal Report. Have a good night, everybody.